Let's jump right in. If you've ever sent money abroad, maybe for your kids' overseas education, to invest in some foreign stocks, or honestly just to book a nice international holiday, you might have noticed a massive chunk of your money seemingly vanish, like poof. Your bank might have quietly collected up to 20% of your remittance amount as a tax. And look, if you're like most people, your immediate reaction was probably sheer panic, thinking, wait, is that money just gone forever? Well, take a deep breath. Today, I'm going to show you exactly what this hidden tax actually is, why it happens in the first place, and absolutely crucial here, how you can get every single rupee of it back. Whether you're a resident Indian sending funds out or an NRI managing money across borders, stick with me through this explainer, because this directly affects your cash flow, and understanding it is just so important. So, did I just lose 20%? It's literally one of the most searched questions out there right now. People are looking at their bank statements, staring at this 20% deduction, and asking themselves, did I seriously just lose 20% of my hard-earned cash forever? And you know what? It's a completely valid fear, especially when you consider that Indians remitted an estimated 31 to 35 billion US dollars recently. I mean, a 20% cut on those kinds of numbers is just staggering. But hey, here's the good news. The answer is a resounding no. No, you haven't lost this money. What you're actually experiencing is a cash flow issue, not a permanent penalty. And this paradigm shift is exactly what we're going to unpack today. Once you really get the mechanics behind this deduction, the panic completely disappears, and you basically take back control of your finances. Okay, so here's our roadmap for this explainer. First, we'll cover the hidden 20% tax. Second, breaking down the LRS. Third, the 3 TCS rates. Fourth, special rules for NRIs. And finally, reclaiming your money. All right, part 1, the hidden 20% tax. So this deduction we're talking about, it's called tax collected at source, or TCS, specifically under Section 206C1G of the Income Tax Act. Now, here is the absolute most important thing you need to remember. TCS is not a final tax. Actually, scratch that. It's basically an advance tax. The bank, acting as an authorized dealer, collects this foreign exchange upfront on behalf of the government at the exact moment you make the remittance. But, and this is the kicker, it is fully creditable against your income tax liability when you file your ITR. Think of it like a temporary lockup of your cash flow. Your money is just sitting safely with the government, waiting for you to claim it. Moving on to part 2, breaking down the LRS. This brings us to the Liberalised Remittance Scheme, or LRS, which was set up by the Reserve Bank of India. Under the LRS, resident Indians are legally allowed to remit up to 250,000 US dollars per individual every single financial year abroad. You can use this for permitted current and capital account transactions. Things like education, travel, making investments, or even just sending gifts to relatives. But here is exactly where those TCS rules kick in. 7 lakh rupees. This right here is the magic cumulative annual threshold. If you send less than 7 lakh rupees in a financial year, for most categories, you're looking at a nil TCS rate. But the moment your total cumulative LRS remittances for that financial year cross that 7 lakh line, boom, the bank is legally required to start collecting tax on the excess amount. Which brings us to part 3, the 3 TCS rates. Now the government doesn't just slap a blanket rate on everything. The percentage you actually pay heavily depends on the specific purpose of your remittance. And this is a vital rate ladder you're going to want to memorize. For instance, if your child is among the 1.3 million Indian students studying overseas and their education is funded by a loan from a financial institution, you only face a tiny 0.5% TCS on amounts above 7 lakh. That's it. But if that education is self-funded, or if you're paying for medical treatment abroad, that rate jumps to 5%. However, and this is a big one, for almost all other LRS purposes, like buying foreign equity, sending wire transfers to relatives, or purchasing overseas property, you get hit with the massive 20% rate. Oh, and note this major exception. For overseas tour packages booked through travel agents, a 5% TCS applies from the very first rupee. There's no 7 lakh threshold to protect you there at all. Okay, let's make this super concrete. Let's imagine a salaried professional named Vikram. He wants to send 10 lakh rupees abroad to invest in US stocks. When he approaches his bank, they're going to check his cumulative LRS remittances for the year. Since he's sending 10 lakh, he's obviously crossed that 7 lakh threshold by 3 lakh rupees. And because this is for an investment, it falls right into that highest bracket. So the bank will apply that steep 20% TCS rate, but specifically on the excess 3 lakh rupees.
The bank collects this money, deposits it with the government, and Vikram? Well, he'll later claim it as a credit when filing his income tax return.
Okay, Part 4, Special Rules for NRIs. Now, if you are a non-resident Indian, you definitely need to pay close attention to this. There's this massive misconception floating around that NRIs also pay this 20% TCS when sending money. Well, they don't. And that's because the liberalized remittance scheme strictly applies to resident Indians only. If you're an NRI remitting your foreign earnings from an NRE account, you're generally exempt from TCS entirely. You operate under FEMA rules, not LRS.
Let's break down the exact rules for the diaspora. First up, inward remittances. When NRIs send money back home to India, that attracts zero TCS, none. And if a resident Indian receives this as a gift from an NRI relative, it's totally exempt from tax under Section 56(2)(x). Now, if you're an NRI moving Indian income out of an NRO account, you are subject to a $1 million repatriation limit per financial year, and you'll need those tax clearance certificates, Form 15CA and 15CB. Now, while LRS TCS doesn't apply here, standard TDS on your Indian income might have already been deducted, so keep that in mind. Lastly, if you're making direct mutual fund investments in India from abroad, you simply need to ensure FATCA compliance. Pretty straightforward.
And finally, Part 5, Reclaiming your money. All right, now for the most important part of this whole explainer, actually getting your cash back. Reclaiming your money is a really simple 3-step process. First, ensure your bank has actually deposited the TCS with the government. Second, check your Form 26AS and your Annual Information Statement, or AIS. The TCS deducted by your bank is going to automatically reflect right there. Always, always verify its accuracy. Third, when you file your income tax return, you simply claim this TCS as a credit. It's either going to reduce your final tax payable, or if you owe no tax at all, it'll become a direct refund straight to your bank account. Just keep in mind this refund process typically takes somewhere between 3 to 9 months, depending on ITR processing speeds. This whole process perfectly illustrates how a little smart planning can completely solve your cash flow problems. You absolutely must track your cumulative LRS across all your travel, study, and investment transactions. If your kid's education is even partly loan funded, double-check that the bank applies the 0.5% rate and not the 5% rate. Also, remember that the 7 lakh threshold applies per individual PAN. This is huge. It means a husband and wife can each remit 7 lakh separately, legally doubling their tax-free threshold to 14 lakh without triggering a single rupee of TCS. And most importantly, always file your ITR to reclaim this money, even if your actual income falls below the taxable limit, for sure. So there you have it. You now have the full picture. You know that TCS is just an advance tax, not a permanent loss. You know the exact rate ladder from 0.5% all the way up to 20%. You know the specific NRI exemptions, and you know the exact steps to claim your refund. The tools are literally right in front of you. So the only question left to ask yourself is this: will you let poor planning unnecessarily lock up 20% of your cash flow with the government for the better part of a year, or will you use this knowledge to take strategic control of your finances? Plan your fiscal year, use those family thresholds smartly, and keep your hard-earned money working for you.